Welcome to those who are joining. We'll give it a minute or two for people to join. If you haven't had a chance to do the pre-survey yet, it is in the chat. So please complete that. Just take a minute or two.
We'll probably start in a couple minutes or so.
And for those who just joined, there's a pre-survey in the chat. And you should have received a resource document ahead of time, but I'll also put that in the chat too, that just make it easier to find for you. And we'll get going here in a minute or two.
Okay, so I figure we might as well just get started now. If you're come in, you won't miss much. It's just an introduction. So I'm Catherine, and welcome to our workshop on understanding personal income taxes. This is a program of the Canadian Foundation for Economic Education in partnership with the National Bank of Canada. And this workshop will last about an hour, and then we'll have a live Q&A for about 30 minutes at the end of the presentation. And these workshops are intended to serve as a foundational resource to get you thinking about your finances, and this one in particular about your income taxes. Not as a final stop in your financial journey, but it's going to carry with you throughout your entire life. So consider the information and see how you can apply the concepts covered to your personal financial situation. And also, please understand that while we do our best to answer all related questions, we will not be discussing topics beyond the scope of today's conversation. And so if you have any specific questions that we're unable to address, consider setting up an appointment with a financial professional. And like we said before, we sent out a pre-survey that we hope you completed, and there'll be a post-survey at the end of our session. And if you fill out both, you'll be entered into a draw for one of 4 $50 Tim Hortons gift cards, chosen among eligible students this semester. And don't worry, we won't use your email address for anything except this draw. So the program Help Managing Your Money on Campus is designed to help support students by providing them with comprehensive financial education modules. And this is so important and timely, especially during tax season, because more than ever, we live in a complex financial world. And the majority of you have likely already experienced this world of financial cost, responsibilities, planning, spending, debt, and credit cards, and so much more. And that's exactly why we partnered with universities and colleges across the country to help equip students with the information they need to take on all of life's financial challenges. So in the first half of 2020, we asked students what their priorities are and what they want to learn more about. And over 1,500 surveys later, here's what we found out. So our research identified that students have 3 major priorities. And we hear your concerns and we understand your challenges, and that's why we put together today's presentation. So today's presentation about personal income tax will help you better understand how Canada's personal income tax system works, and will give you more control over your money, which helps to lower your financial stress and increase your financial well-being. So as you heard, taxes impact every part of our lives, so let's learn more about them. Here's what we're going to cover today. Canada's tax system, the more you make, the more you pay, both in terms of dollars of income tax, but also the percentage of your income. Tax returns for students will review deductions and credits available to you. and tax strategies, which are ways to reduce taxes payable and keep more money in your pocket throughout the year. After this workshop, you'll have a better understanding of how to minimize taxes as a student by being aware of tax deductions and tax credits. You'll be aware and be able to take advantage of the tax efficient government savings programs. And lastly, you'll know how different sources of investment income are taxed quite differently. So if you're interested in investing, that'll be especially important to you. So Canada's income tax system is progressive. That means the more you make, the more you pay. Most countries follow a tax system like this as it helps lower income people keep more of their income and tries to ensure higher income pay for more of the services the government offers. So it makes it a little bit more fair. So let's look at Canada's tax system. We're going to start by looking at how our tax systems work and what it covers. Then we'll talk about federal and provincial tax rates. And finally, the difference between taxable and non-taxable income. So everybody knows about taxes. Usually you hear people complaining about taxes, but why do we pay them? In Canada, the personal income tax system started in 1917 as a temporary measure to help pay for the costs of World War I. But as you can see, it kind of stuck, and we pay taxes to this very day. Taxes are payments that we make to the government, federal, provincial, and municipal, and they're means by which the government receives the money to provide goods and services to the public, which is, you and me. The primary goods and services are called provided by the government through taxes are called public goods and services. And this includes things like public schools, hospitals, sidewalks, roadways, sewer systems, the vents, the judicial system, courts, and so on and so forth. So here's a rough breakdown of where your taxes go as of a few years ago. Some examples are roughly 15% go to the elderly, so like old age security, guaranteed income supplement. 12% goes to provide all of us with healthcare. As you know, it only goes so far. Like sometimes you have to pay through your job with prescriptions or dental, but it covers a lot of things through your taxes. And roughly 8% goes to servicing the outstanding debt. And I'm sure you could always look this up online if you want more information about where your taxes go. So Canada has a progressive tax system, as I mentioned before, where taxes are based on the taxable amount of an individual's income. This is a very equitable way of helping lower income Canadians receive services by transferring more taxes from higher income residents. So federal tax brackets vary from 15% and 33%, but provincial taxes are on top of those federal taxes, and many provinces also have additional surtaxes on higher levels of income. So our system results in individuals having our marginal tax rate. The percentage of your taxable income you pay increases at certain intervals. So for example, for each dollar of the taxable income over $53,359, you will pay a 20.5% in federal income taxes versus the 15% of the first $53,359. This is an important concept to be aware of as your income increases during your working career. So only the first portion of that $53,000 will be 20.5%, and then every dollar over that will be taxed an additional 50%. The marginal tax rate is the rate of your next dollar of income taxed at. It's not necessarily the same as your average tax rate, since your first $53,000 will always be taxed at the lowest bracket, no matter what your marginal tax rate, and so on. Ontario has the highest marginal tax rate at 53.53%. So every dollar you earn, employment or self-employment income plus other income, over $235,000, you pay more than half in income taxes, but not on all of your income, only what falls into that bracket. Oops. So let's look at some specific numbers. You might want to take a screenshot of this screen, or you can look up more information at taxtips.ca, which is also contained in your resource packet. Canadians, federal, provincial, and territorial governments require that their residents pay income tax when their income is above a minimum amount, as mentioned before. And this means that most people who earn income above the minimum pay 2 income taxes, one to the federal and one to the provincial or the territory they live in. So now let's say in 2023, you earned $60,000 on taxable income. You would be paying in tax brackets, the first 53,000 would be taxed at 15%, which let me just open up. I actually have an Excel document, which is also available to you in your resource.
And actually, the Excel document is in the chat right now too, if people want to download it from there.
Yeah, so if you want to follow along in there, feel free to do so. So as you can see at the top, we have our income of $60,000. And down here, if you scroll down, you'll have your federal and Ontario taxes. And as you can see, the first $53,000 will be taxed at a 15%, but that leaves us with some over that because we have $60,000 in income, right? So the remaining amount would be $1,000, $1,300 roughly, from the 20.5% tax rate. And feel free to make a copy of this spreadsheet and play around with the numbers. So you could always change the amount from, let's say we made $100,000 this year, and that would greatly change the amount that you pay in taxes. So as you can see, we didn't quite make it to the next tax bracket of 26%, which means we would pay $8,000 in the first bracket and then $9,000 from the income made above that bracket. So anytime taxes are withheld, like for example, you get paid on a bi-weekly basis from your job, that is an estimate and will be trued up when you file your taxes. So those taxes that are withheld on your paycheck are kind of only an estimate. Note that the government withholds taxes on your paycheck. The government recognizes that if they waited until the following year to collect all the taxes you owed from the prior year's income, there's a good chance you wouldn't have the money. Because as you know, I know I'm not really good with saving my money. So it's a good thing the government practices this discipline called pay yourself first to ensure that they're saving money for future on an ongoing basis. And of course, if there's any discrepancies between the amount that's withheld and the amount that you actually owe, you will either have to pay more if you made more than that, or you'll be refunded if you actually don't owe as much taxes. So note the term taxable income. That's because you may not be taxed on all your income. Certain deductions may be able to be claimed to arrive at taxable income. For example, if you make contributions to your registered retirement savings plan, also known as the RRSP, that amount may be deducted from your income, reducing the amount of taxes you have to pay. So for example, if we go back to our sheet here, if I say contributed $5,000 to my RRSP, that would actually reduce my taxable income from the $100,000 I had here to $95,000 instead. And they would use that taxable income, the new taxable income, to come up with what I would owe in taxes. There are also other deductions you might be able to earn. So some other examples of deductions include moving expenses if you had to move more than 40 kilometers to take a job, and childcare expenses for children under 16 years old. Granted, some of these there are exceptions where they might not be included, so be sure to do your research. And there's also, aside from deductions, tax credits. So deductions reduce your taxable income, whereas tax credits are amounts that reduce the tax that you pay on your taxable income. So the tax has already been calculated, but the credit will reduce that taxable amount. The more tax credits that apply to you, the more you can reduce your income tax. So everyone who files a tax return gets the basic personal amount, also known as the BPA, as a non-refundable tax credit. So it reduces your tax payable, and if you earn less than the 2022 federal filing amount of $15,000, you'll pay $0 in federal income taxes. So if you made less than $15,000 that year, you won't have to pay any income tax. But if you don't owe any taxes, it won't generate a tax refund, thus the non-refundable label. Please remember that even if you are making less than the BPA, it's still important to file your taxes in order to prove this. So even though you may not have to pay taxes, it's always a good idea to still file them. In addition to this, certain medical expenses over a certain dollar amount each year or charitable donations can also result in a tax credit that can reduce taxes payable. But make sure to keep all of your medical and donation receipts as you pay for medical costs and or make donations, because you always want to be able to prove these things to the government should they come to you and ask for proof. So I'm going to show you a short video that explains the difference between deductions and credits. It's a US video, but the concepts are like generally the same as here in Canada. Give me 1 second here to set it up.
All joy you can get from it is in watching your tax bill go down as you add in deductions and credits. But what exactly is the difference between a tax deduction and a tax credit? Aren't they kind of just interchangeable? While both can be good for your final tax return, they are very different. First up, let's look at tax credits. A tax credit reduces your overall tax liability. So if you have a $1,000 tax credit, that means you no longer owe $1,000 on your taxes. A tax deduction reduces how much of your income gets taxed. Let's say you have a $1,000 tax deduction. It is applied to your top income tax bracket. So if you made $55,000 last year, your top tax bracket is 22%. That deduction means of $1,000 of your income.
Nope, sorry.
The market can look scary. These days, you might be thinking,
Filing taxes deduction reduces how much of your income last year. Your top tax bracket is 22%. That deduction means of $1,000 of your income won't be taxed. So you save that 22%, which would equal $220. This all makes tax credits sound pretty great, right? Most of the time, yes, but there are some catches. Many tax credits aren't refundable. What that means is, let's take this $1,000 tax credit again. But let's say you only owe the IRS $600. You don't get that extra $400. Not all.
So the rest of that kind of goes into the more US side of the taxes. So I'm going to stop it there.
Filing taxes is really no big.
That's not good. Okay, so here's some key takeaways from our first section. Yes, you have to pay taxes, but they pay for many services that you receive. We have a progressive tax system, which means the more money you make, the more you pay. Taxable income matters, so make sure you learn about the tax deductions that may be available to help reduce your taxable income and the tax credits you can claim to reduce the amount of taxes that you need to pay. So the next section is going to go into specific tax issues that students need to keep in mind. So here's what we're going to cover. We're going to look at a few ways to reduce the taxes that are withheld from your pay, the top deductions and credits for students, and the importance of having a tax plan. So there are 3 ways to reduce your taxes that are withheld from your paycheck. First is to give your employer accurate information. And when you start a new job, you must complete the TD1 personal tax credits return. Your employer uses this form to calculate how much tax to deduct from your paycheck based on the non-refundable tax credits you are entitled to. So for example, say your spousal amount, caregiver amount, your tuition and education amounts. Second is to tell your employer your personal circumstance. If your circumstances change. For example, that might mean you are entitled to additional or fewer tax credits. So you would have to complete a new TD1 form. So for example, if you get married or enroll in a university or college. And lastly is to ask the CRA to apply other tax deductions. So if you complete and file the form T1213, request to reduce tax deductions at source, if you know you're going to have significant deductions in a given year. So for example, if you have RRSP contributions, rental losses, childcare expenses, give the approval letter you receive from the CRA to your employer, and they will reduce the taxes taken from your pay. So this is kind of like getting ahead of the problem before tax season comes. So you must file your taxes annually to receive any of these benefits. Students and tax, there's the tuition amount. There's two non-refundable tax credits, first of which is the tuition amount. Tuition fees are an excellent example of a non-refundable tax credit. And seeing as many of you are students here, this will be very important for you guys to understand. And you can claim tax credits for tuition fees, which is what you pay to go to the school from a post-secondary source, but it has to cost more than $100, and you need to ask your school for a form called the T2202A. And I can actually show you guys where to find it. 1 second here. So if you go to your MySU College page, and you go to records here. If you scroll down to your financial records, you will find your income tax T2202 form and then the T4 form. And if you click it, it will send an email to your student account with the necessary form, and you can print it off, bring it to your accountant or a bank, or you could do it yourself with your own income taxes, and it'll help reduce the amount that you owe. The second part is, examination fees. So say you're a nursing student and you're required to take the NCLEX exam, which is, costs money to take to obtain a recognized professional designations or license or a certificate to practice a professional trade in Canada. So make sure to save those receipts to be able to put them towards your tax credit. If you want to learn more about eligible tuition fees, you can go to the CRA website to learn more information about it. There are also additional credits such as transfer credits, which is up to $5,000 to a supporting parent, grandparent, or spouse before you can transfer the credits. You must apply them to your own tax return and reduce the tax you owe to zero. And you can also carry forward credits indefinitely, but you have to claim the carry forward amount in the first year that you have to pay tax. So say you actually had a tax credit from a previous year, but you didn't get to use it, you can't carry forward that amount. You would have to use it within that first year. The second part is interest on student loans. So if any of you guys are from Ontario and you've done OSAP, you can use that amount. You can only claim interest on student loans made to you under the Canada Student Loans Act and the Canada Student Financial Assistance Act, or any similar provincial or territorial government laws. You can't claim interest paid on any other kind of loan, even if it's to finance your education. For example, if you got a line of credit through your bank, that's not an eligible interest on student loans. There are also some tax deductions, such as moving expenses, as I mentioned before. If you're a full-time student and you had to move to be at least 40 kilometers closer to school, you can claim a tax deduction on that. Just remember that there are some guidelines you have to follow to use this. You can only get this deduction by applying it against the tax you're required to pay on scholarships, bursaries, fellowships, prizes, and so on. And if you qualify for the deduction, use form T1M and enter the amount on line 219 of your return. And these examples of these eligible moving expenses may include transportation and storage costs, temporary living expenses, for example, if your apartment is not ready yet, and incidental costs such as changing your address on legal documents, replacing a driver's license, and even utility hookups and disconnections. And there are also GST and HST credits, which is up to $467 per year if you're single, and you receive $0 GST credit if your net income is over $49,000. So some of you may be self-employed, either in a traditional sense, such as a consultant or a contractor, or through the gig economy, such as, Uber Eats or stuff like that. You may be able to deduct business expenses, like a portion of your home expenses if you work out of your home, a portion of your car expenses if you use your car for work, a portion of meal expenses if traveling on business, and so on and so forth. So as long as you can prove you used it for a business purposes, you may be able to use it as a deduction. So you can receive some business deductions, and then you file a normal individual tax return as a self-employed individual. It is a little bit more complex than the normal personal income tax, and we could do a whole workshop on it really. So please refer to the resource document from the CRA. So tax planning. So plan ahead in 5 steps. The first is to start your tax planning early. At the beginning of the year, plan how you're going to arrange your financial affairs to lower your tax bill. And to help you get started, check out the tax tips from the Canada Revenue Agency. Second is to keep good records and receipts throughout the year. So always keep everything organized and together and like things together. Organize and file your receipts as they come in, and this will make it so much easier at tax time. And this includes tax from information slips, as well as supporting documents such as bills, credit card statements, medical expense receipts, and as I said before, like any donations you made, receipts for cars, home office, and other business expenses, and housing, business, and rental property records. The third is to make sure you receive all tax information slips, and this includes receipts for the RRSP contributions and donations. It includes T4 slips if you're an employee, the T4A slip if you received a pension income, lump sum payments, self-employed commissions, or annuity income, T3 if you've earned income from a trust, and T5 if you've received investment income, such as from interest or dividends. The fourth is decide if you need tax preparation help. And if your tax return is fairly simple, for example, you only have employment income and an RRSP deduction, you can probably prepare it yourself using one of the many software programs, such as TurboTax, and you might have heard of it before. So there's some on your list, which are compatible with the CRA's NetFile program. And lastly is to prepare summaries and organize your receipts. I can't stress enough how important it is to keep everything nice and organized. So before going to a tax professional, summarize your different sources of income and your deductions and tax credits, and this will save you money in tax preparation fees. You may also want to provide a cover letter that provides a quick reference information to the accountant, which may include your name, social insurance number, number of employees of the employers of the year. So say you moved around and you changed your jobs a lot, and who they are, your student status, your marital status, and whether they received government funding or any grants and bursaries. You would still have to provide all of the documentation, but the exercise is a great way to make sure you don't miss anything from the year. So just think about where you started at the beginning of the year and where you are now, and work through it on a step-by-step basis. So who must file taxes? So some of you guys may be international students, and you're a resident of Canada for tax purposes if you establish significant residential ties with Canada. So if you've earned income and established significant residential ties with Canada, you'll have to file for income tax. You are a non-resident of Canada for tax purposes if you do not establish significant ties with Canada and you stay in Canada for less than 183 days during the year, which if you don't know, 183 days is like 6 months plus a day. So if you were just a little under the 6 months mark, that will not qualify as significant residential ties. And you're deemed a resident of Canada if you do not have these significant ties, but you stay for 183 days or more in a calendar year. So even if you go back and forth, as long as it adds up to 183 days, it still counts. And you are not considered a resident if your home country under the terms of a tax treaty between Canada and that country. So it's always a good idea to look up these tax treaties between Canada and your home country, just to get some more information, because every tax treaty is just a little bit different from the other. So who can prepare your taxes? Many people who don't have complicated financial situations will prepare and file their own tax return using off-the-shelf tax preparation software, as I exampled before, TurboTax and Wealthsimple. If you're uncertain about what can and cannot be claimed, or if you have some complicating factors, you may want to enlist some help. So perhaps your parents can provide some help or enlist the help of their tax preparer, such as my case. I usually use my mom's accountant to help with my taxes. And these professional providers who can help too, but they do generally charge a fee. As you know, nothing's free in this world. Many schools and communities have a volunteer tax program if your income is below a threshold, and if your taxes aren't too difficult, the volunteers will complete your taxes for free. So for example, Sioux Colleges is actually having a tax volunteer program run by the tax students or the accountant students. So look into that for more information. And since it is a volunteer program, it is for free. And if your financial affairs are more complicated, you may need expert advice. For example, if you're self-employed or earn investment income, you may want to hire a tax professional to recommend strategies for minimizing and deferring your taxes. Fees may pay for themselves in terms of tax saving. So try, if you can, to speak with a CPA or chartered professional accountant who specializes in income tax. Another benefit of using tax specialists or accountants is if they mess up, they generally tend to have like insurance to help cover this. Whereas if you have a very complicated tax situation, you would have to pay for that out of pocket by yourself. If you use a service, you should check them out to make sure they are legitimate and the reviews of their services are good and that the costs are not excessive. Also, with any contract you sign, you need to review the details before you sign and make sure you understand what is your responsibility, which is most items, and what the taxpayer is responsible for, doing the best with the information you provide them. So if you miss a source of income, etc., that's your responsibility because the tax preparer can only use what you've given them. They know nothing about your situation. So some key takeaways from this section is to learn about deductions and credits to help try and maximize the benefits. Don't leave your taxes until the last minute and keep a good record of every month of receipts, such as medical expenses and moving expenses. And lastly, more than likely, you can complete your own taxes if they're not too complicated, and the investment of time and learning can give you great return on the investment on your time. So the important thing about filing and paying your taxes is to make sure you file your tax return and pay the required tax on time. The deadline is April 30th to file your taxes. In 2020, they gave an extension to this due to COVID-19, but I'm pretty sure it's not valid anymore. Tax evasion is illegal and generally involves not filing your tax returns on time, claiming false deductions, or not reporting all of your taxable income. Tax evasion is against the law. It's a really big deal. They love their taxes. In contrast, tax minimization refers to legal steps you can take as permitted within the tax laws to reduce your tax burden. So one of the ways you can reduce your tax burden is to make sure you claim all of the tax deductions and tax credits you're entitled to. You can also reduce your tax burden by contributing money to the RRSP, as I mentioned before, or setting up a TFSA, also referred to the tax-free savings account. So these ways to reduce your taxes are also referred to as tax minimization strategies, and they're perfectly legal. So, you compare tax minimization to tax avoidance. One, you will get fined or go to jail. The other is a perfectly legal way to minimize your taxes and maximize benefits. So here's what we're going to cover in this section. First is various sources of income that are taxed differently, and these differences can lead to varying different tax rates. Then we'll talk about the tax benefits of the RRSP, Registered Retirement Savings Plan, and the tax-free savings account. So if you put your investments into a non-registered or unsheltered account, you pay income taxes on the money you earn in the tax year of which the income was realized. So the amount of taxes you pay depend on the type of income you've earned. Interest income, you can return interest income from many sources, from a bank account, a guaranteed investment saving plan, a bond, a mutual fund that holds interest paying investments from and non-Canadian dividends. All of this income is fully taxed at your marginal tax rate on an ordinary income. So $1 interest is $1 of income. Dividend income, if you own common or preferred shares in taxable Canada or corporation, or own units of a mutual fund that invest in such common and preferred shares, you'll probably have dividend income. So dividends are cash payments to shareholders of a corporation made from the corporation's profits. So which rates are more favorable tax treatment than interest income, especially if your annual income is under $100,000 per year? So the taxes you owe on dividends is a complicated process, including gross ups and tax credits. For someone in Ontario, BC with an income below $50,000, the tax rate on eligible Canadian dividends is less than 0%. I repeat, in some parts of the country, eligible Canadian dividends can have a negative tax rate, meaning it actually decreases the taxes you owe in other areas as a reward for investing in the Canadian economy. So if you invest in a Canadian business and you receive dividends from that, there's a very good chance you won't have to pay interest tax on that, or it may actually reduce the amount of taxes you owe. The end effect is the amount of taxes you pay on dividends is relatively low, sometimes even negative, making dividend income very attractive. However, dividends from foreign companies are not eligible for this treatment. So again, it's only for Canadian companies that you invest in. Next is capital gains and losses, but it's only when you sell a stock. So let's say you bought 100 shares of ABC Corp, $10 a share. It was a brilliant move. ABC Corp is now worth $100 a share as compared to the $10 you bought it for. And you decide to take some profits and sell 50 shares, half your investment. You reap $5,000, realizing a profit of $4,500. That's a $4,500 is a capital gain. So what makes a capital gain attractive from a tax point of view is that you only bring 50% the gain or loss into income. So in our ABC Corp example, you would include only $2,250 in your income for that year. So it'd be half of the income you earned. And that amount would be taxed at your marginal tax rate. The other advantage is to capital gains or losses, as there's no tax triggered until an asset such as a share is sold. So that's, say you bought those shares, the amount is going up and down, up and down. You won't have to pay any tax on that until you actually sell the share and that amount is realized. So say you waited more and you wait until your shares reach $500 a share and you pay no taxes until you sell them. So this allows you to defer realizing the gain or loss until a time that is tax efficient for you. So understanding the tax consequences of your investments can make a difference to your financial well-being. So talk to your financial advisor and he or she will have more information on the taxation of investments and can suggest some strategies that will help maximize your effectiveness. So we're just going to open a poll for you guys just to get a little feel. Do you have a TFSA, and do you know where you can open a TFSA? And the second question, regardless of whether you have a TFSA, do you know where you can get one at some point? So choices are like financial institutions, credit unions, insurance company, or all of the above.
Okay, we'll just give maybe 10 more seconds on the first poll question, and then I will share the results with you, Catherine.
Perfect.
Here you go. Can you see those?
Yep.
Okay.
So it seems that all of you guys don't have a TFSA. So that means it's a really good idea for you guys to look into getting one. And the
And
second
there's-
question is, do you know where to set up a TFSA?
And we'll again give it another 15 seconds or so. There you go.
Okay, perfect. So the answer is actually all of the above. You can you can open a tax-free savings account at a financial institution, credit union, insurance company. So it's always good to check into these things. So there's some savings and investing strategies and products that you can use to help reduce taxes. So for example, as we mentioned, the tax-free savings account may allow you to earn income without paying tax. So you can deposit money into the savings account up to a certain annual limit to save for the future. And any income or gains that you earn on this investment held inside the tax-free savings account are not taxable. So regarding making a TFSA contribution, unlike with the RRSP, you can't deduct your contribution from the income you report on your tax return. But here's how it works. You don't have to have earned income to contribute to the tax-free savings account. You don't have to set up a tax-free savings account or file a tax return to earn a contribution room. You have to be 18 years or older and have a valid Canadian social insurance number. And for 2023, the tax-free savings account contribution is $6,500. So if you don't contribute the full amount you're allowed in any 1 year, you can carry that amount forward in any unused contribution room based on your contribution limits for each year. So in 2023, you can contribute up to $88,000 if you were 18 and a Canadian resident with a SIN when they were first introduced. And if you take your money out of the tax-free savings account for any purpose, you can replace an amount the following calendar year, but not before that, or there'll be fines. So say you take $1,000 out this year, you wouldn't be able to put that amount back until the next tax year. Because our registered retirement savings plan gives you a tax deduction based on your marginal tax bracket, it's actually more valuable to contribute to the tax-free savings account first if your taxable income is greater or less than $50,000. Your marginal tax rate will thus be lower in the low 20%. Any individual who is 18 years or older and who has a valid social insurance number is eligible to open a tax-free savings account. If you're a US citizen, through the beneficial tax treatment of the TFSA will not be valid when you file your US income taxes. And also any contributions made while you are non-resident will be subject to a 1% tax for each month the contribution stays in the account. So if you deposit your money into our RRSP to save for the future, you get a tax deduction for the funds deposited, again, only up to a limit into an RRSP. And this can also help you reduce your taxes in the year. The money is deposited into the RRSP, but be aware that the money is taxed when it's taken out of that account later. This registered retirement savings plan is meant to serve as a saving vehicle that allows Canadians to save their retirement tax efficiently. So that means when you take that money out, you're going to be taxed on it. This allows Canadians to save for their retirement tax efficiently, and when money is withdrawn, that tax will be a lower tax rate than when you were working. So you must have earned income to contribute to the registered retirement savings plan. To start building this registered retirement savings plan contribution room, you have to file an income tax return. So even if you don't owe any tax, you still have to file this tax return. Your notice of assessment will tell you how much money you can put into your registered retirement savings plan each year. So that's why it's important to always be filing your income tax. So here's how it works. You can claim up to a certain limits each year. For 2023, contributions to your maximum is $30,780 or 18% of your 2022 income. If you have a pension plan, your RRSP contribution will be reduced by an amount known as a pension adjustment or PA. Your PA is reported on your T4 slip each year, which is given to you from your employers. And this may reflect how much your employer contributed to, say, like a group registered retirement saving plan for your benefit. If you don't contribute the full amount you're allowed in any one year, once again, you can carry that amount forward and use any unused contribution room. So it's kind of similar that way to the tax-free savings plan. You don't have to deduct amounts in the year you contributed them. So for example, you can wait until you're in a higher tax bracket. So once again, this is only for individuals who are 18 years or older and who have a valid social insurance number. And international students may begin contributing to the RRSP before obtaining or applying for permanent residency, as long as you have a social insurance number and have earned income and file an income tax return in Canada. So this is just to show you guys some differences between the tax-free savings account and the RRSP. While they're both storage containers, to use a popular illustration, meaning you can put investments in them, and you should note some important distinctions. A TFSA can be contributed to without any income, so you don't have to earn any money to put money in your TFSA, whereas you can only place a percentage of earned income into the RRSP, which is typically around 18% up to an annual limit. Contributions to a tax-free savings account are not tax deductible, whereas contributions to an RRSP are. So once again, it's typically only beneficial to put into the RRSP if you've earned up to that, roughly around $50,000. Unlike an RRSP, any money you take out of the TFSA is not taxed, and thus the tax sheltered status. RRSP withdrawals, you do have to pay taxes on them, thus the tax deferred status. But typically, if you wait until you're retired, that taxable amount will be lower than if you were working. Both the TFSA and the RRSP have a cumulative contribution room. So that means if you don't use all of your annual limit, you can carry that forward to the next year and so on. Also, it's worth pointing out that you can contribute to use a TFSA for tax-free investment growth your entire life, whereas the money in an RRSP must be transferred to a different type of account after age 71, which is why it's called the registered retirement savings plan. So from some key takeaways from this part, the Canadian dividends may be taxed at a negative rate if you file the first marginal income tax bracket. Capital gains are taxed at 50% of income rate. Interest income is taxed at the typical marginal income tax rate. And lastly, a TFSA is likely the better option of an RRSP if your taxable income is less than $50,000. So again, a lot of you guys said you didn't have a tax-free savings account, which makes it even more important for you guys to look into one and probably sign up for one. So let's review what we've learned today. Yes, you have to pay taxes, but they pay for many services you receive, such as the roads and the hospitals. We have a progressive tax system. The more money you make, the more your taxable income matters, and the more you pay. Taxable income matters, so make sure you learn about the tax deductions that may be available to help reduce the taxable income and the tax credits that may be able to be claimed to reduce the amount of tax that you need to pay, such as your tuition. Tax returns for students. Let's learn about the deductions and credits for students to try and maximize the benefits. Don't leave your taxes until the last minute. And more than likely, you can complete your own taxes, and the investment of time and learning can give you a great return. So the more you learn about your taxes, the more you can learn in the future. And maybe if you file your taxes this year, you can look into probably investing and add it on to your next year's taxes. So Canadian dividends may be taxed at a negative rate. Capital gains are taxed at 50% of income rate, and interest income is taxed at a typical marginal income tax rate. And a TFSA is likely a better option than an RRSP if your taxable income is less than $50,000. So hopefully coming out of this workshop, you'll have a better understanding of how to minimize taxes as a student by being aware of tax deductions and tax credits. You'll be aware and be able to take advantage of these tax efficient government savings programs. And lastly, you know, different sources of investment income are taxed quite differently. So taxes are typically due April 30th, which is less than 2 months away now. So maybe you're not ready this year. So to plan for next year, you should learn about the deductions and credits you may be eligible for and keep a running total of those items throughout the year, especially if you're moving or you make any donations. So now that you know about these things, you'll be able to keep better track of them. It can also be a great return on investment, and a TFSA is likely the better option versus an RSP when just starting to work. So hopefully I beat that into your head close enough to look into getting a TFSA. So that's it for today. I'll open it up for a Q&A, but please complete the post-workshop survey. It's important to ensure that we are providing you with the information you need. And if you complete the pre and post survey, you'll be entered into a draw for one of 4 $50 Tim Horton gift cards. But granted, that draw is over the whole kind of semester.
Great, and thank you very much, Catherine. Great job on going through all of this challenging topic, and hopefully folks have some good takeaways. Definitely, I would echo Catherine's comments as far as definitely look into opening up a TFSA. It's a great way to save taxes, and it's one of the few sort of free lunches in the tax system. So please look into that, and if you have the opportunity, take advantage of tax-free savings. So if folks have questions, if you could drop them into the Q&A. Between Catherine and I, we'll do our best to answer any questions you may have. And I did put the post survey is in the chat, so if you do have a chance to complete that as well, we would appreciate that. The feedback is helpful, and there's potential to win a $50 Tim Hortons gift card. So again, feel free, any questions you have, drop them into the Q&A, and explain everything too well, Catherine. There's no questions.
That's good to hear. Hopefully everyone has all they need to know about filing their taxes for this year, or maybe they'll be more prepared for next year's taxes instead.
Yeah. We'll give it one more minute, but if there's no questions, no need to hang around, but we'll give folks another minute or so if there's something.
Maybe it's a really long question. Who knows?
There's typing and
Okay, I think we're probably ended here today then.
yeah, I'm just going to pop that resource document into the chat again. I had done that earlier, but yeah, thank you very much, Catherine, for all of your time you went into preparing this. Thank you everyone for attending,
No problem.
and good luck this tax season.
Have a great day, everyone.
I know.